China responds to Trump's tariffs, market reactions and bond market dynamics. In the latest development, China has condemned Donald Trump's tariffs as tyranny, emphasizing the need to take action against them. CNBC's Frank Holland joined the discussion, analyzing the market's response to the ongoing trade situation. Yesterday, the Dow surged by nearly 8%, while the S&P rose 9.5%, marking its most significant gain since the 2008 financial crisis. However, despite the recovery, the markets have not yet returned to last week's levels. Holland provided an overview of the market's behavior, explaining that futures this morning are seeing declines, with the S&P and NASDAQ both down around 2%. Following Trump's announcement of a tariff pause for most countries, the markets had rallied significantly. Notably, China was excluded from this pause, and in response, its tariffs were increased to 125%, prompting retaliatory measures. While the historic rally was impressive, with the NASDAQ enjoying its best day since 2001 and the S&P experiencing its largest gain since 2008, it's important to note that both indexes remain significantly below their 52-week highs, indicating they are still in correction territory. Holland also discussed the evolving market sentiment, noting that some estimates suggest new tariffs might be set between 15–20%, still historically high. The fears of a recession have somewhat eased, with Goldman Sachs revising its forecast from a 65% chance of a US recession to a more optimistic outlook. A key factor influencing market behavior is the bond market. Holland highlighted that yields had risen, with many investors, referred to as bond vigilantes, selling off bonds due to economic or debt-related concerns. This shift in the bond market has reportedly caught the attention of President Trump, as Treasury Secretary Steve Mnuchin and others indicated the administration was closely monitoring these changes. Rising yields have pressured the equity markets and signaled a loss of investor confidence. In the bond market, Japan, a significant bondholder, along with other countries, has reportedly been selling US bonds, raising concerns about investor confidence in the US economy. According to some sources, this bond sell-off influenced Trump's decision to announce a 90-day tariff reprieve. Additionally, corporate reactions are mixed. Goldman Sachs and UBS downgraded Tesla, with UBS also cutting General Motors' stock target. Meanwhile, concerns linger about the impact of tariffs on the automotive sector. In the tech sector, there are differing opinions. Brad Gerstner from Altimeter Capital spoke positively about reassurances from big tech CEOs regarding the tariff situation. However, tech analyst Dan Ives of Wedbush predicted a pullback of 10–15% in AI spending, citing tariff-related uncertainty, which led to downgrades for major tech stocks like Microsoft. The upcoming CPI report on inflation is also a key focus, with estimates pointing to a slight decline in the inflation rate, which could have further implications for the bond market. In political developments, Treasury Secretary Mnuchin affirmed that President Trump's negotiating strategy was intentional and has encouraged over 75 countries to negotiate. Some suggest that Trump's approach pushed China into a difficult position, ultimately proving advantageous for the US in trade negotiations. Fox Business Charles Gasparino, however, offered a different perspective. He argued that the decision to pause tariffs was more a response to the bond market's alarming sell-off than a strategic calculation by Trump. Gasparino pointed to the rising yields on long-term US bonds and the fact that Japan, a major bondholder, was selling off US debt. He believes that the bond market's instability played a crucial role in prompting the 90-day pause in tariffs. Finally, Zanny Minton Beddoes of the Wall Street Journal emphasized that while the immediate crisis in the bond market has been alleviated, the broader economic uncertainty persists. Despite the relief from the tariff pause, the ongoing trade war with China and the uncertainty surrounding international negotiations mean that the damage to businesses and markets may not be fully resolved.